Good morning, everyone, and thank you for joining us for the webinar today. I'm pleased to introduce Chris McCauley, Director of Compliance for ProBenefits.
Good morning, everyone, and welcome to today's webinar. I am Chris McCauley, benefits attorney at ProBenefits. Today's presentation is an update on FSAs and HRAs. As always, all attendees and all registrants will receive a copy of the a copy of the slides and recording in email form after the presentation. Also, you can provide us with any questions you might have in writing by using the dashboard on the right side. Just click on the questions box and go ahead and submit any questions you have in writing. Today's session, again, we're going to talk about FSAs and HRAs and the number of legal developments impacting FSAs and HRAs in 2016 is relatively limited. So what I wanted to do is talk about FSA, general FSA compliance, and then talk about the few additional updates that there are. Also talk about HRA compliance, the general compliance rules, and then have a brief discussion about ACA compliant HRA plans, and then again answer any of your questions. So if we can move along to the slides, it looks like right now there we go. So again, that's our outline for today's session. Let's jump right into the presentation. Again, the number of new legal developments impacting FSAs for 2016 is relatively few, so I wanted to just touch again on the basics, talk about basic FSA compliance before jumping into the few new items. First, FSAs are a mechanism for employees to pre-tax some of their own money in order to pay for eligible medical expenses that they incur out of pocket. Employers can contribute some money to that as well, but for the most part it's used as a mechanism for employees to pre-tax their own dollars. The IRS says in order to get the pre-tax benefit, the plan and the employees have to follow a set of rules, and there are a number of legal requirements that apply to FSAs. First set of requirements is the IRS rules, which say that the FSA plans can only reimburse certain expenses for certain individuals, the employee's spouse, or certain qualifying dependents. The FSA also can only reimburse certain types of expenses, and those are medical, dental, or vision expenses allowed by and meeting the definition of medical expenses in IRS Section 213D. In addition, FSAs have a couple of specific requirements. The uniform coverage rule, which says that an employee that makes an election must have that election available to them at the beginning of the year, the full amount. So even though they contribute generally month by month, the first month of the plan year, the entire election is available to them if they do have an expense for reimbursement. Also, most FSA plan years are 12-month plan years. There's an exception for certain short plan years in certain scenarios, but again, standard is 12-month plan year for FSAs. And then finally, everyone is generally familiar with the use it or lose it rule for FSAs. You make an election at the beginning of the year, and you either use that money or you lose that money, except we have a few now, two exceptions to that rule. The grace period, which gives an employee an additional 2.5 months to incur expenses to use their FSA money, or the health FSA carryover, which allows an individual to carry over remaining dollars to the new plan year. Also, there's ownership participation is generally limited depending on the type of entity. Other than a C Corp, most owners are ineligible to participate in an FSA plan, and there's non-discrimination rules under IRS Sections 125 and 105H. FSAs also have ERISA requirements, which I'm not going to go into detail because we have presented a number of webinars on ERISA and the requirements of ERISA. So I just wanted to list them here so you can see them. If you want more detail, the ERISA presentations are on our website that we have presented in the last couple of months. Health FSAs are also group health plans subject to COBRA. They are generally subject to limited COBRA, unlike major medical, dental, or vision plans, and we're going to talk about that a little bit in a second. And there are also some ACA considerations for FSAs, which we're going to talk about in the upcoming slides as well. So I did want to touch on probably the most significant legal development in 2016 regarding health FSAs, and that came a couple of months ago in the form of IRS Notice 2015-87. And really what the notice did was provide us some guidance regarding the carryover, the health FSA carryover. Many of you are probably aware that the carryover feature was added or permitted by the IRS starting in 2013, and what it did was it modified the use or lose rule. So no longer is it use it or lose it. If the plan implements the carryover feature, then employees can roll up to $500 of unused funds from one year to the next. The carryover feature was great. It helped out participants and it helped out employers who wanted to provide a good benefit to their employees with maximum tax savings. But it did leave us with a few questions. So when carryover was implemented, it didn't answer all of our carryover questions. So we did have some outstanding carryover questions, especially as they relate to COBRA. And so the IRS helped us clarify some of those questions. So just as a point of background, health FSAs are group health plans subject to COBRA. Although, again, unlike medical, dental, and vision plans and HRAs and other group health plans, FSAs are generally subject to limited COBRA. What limited COBRA means is that that COBRA only needs to be offered to employees that have underspent their FSA account when they terminate participation. And what I mean by underspent is that they have been reimbursed less than they have contributed for the year. So that's someone that has been underspent their account. So those are the only FSA participants that need to be offered COBRA. So that's limited COBRA. In addition, that coverage, that limited COBRA coverage for FSA only needs to be offered until the end of the plan year generally. So that's another aspect of limited COBRA. General COBRA for the major medical plan has a maximum coverage period of generally 18 or 36 months, but FSAs are subject to limited COBRA, so they generally only need to offer coverage through the end of the plan year. Prior to the notice coming out a couple months ago, there were still some outstanding questions regarding how carryover impacted this COBRA analysis, so we were glad to get that notice here in 2016. So as we move to the next slide, we'll talk about exactly what the notice said. First of all, the first thing it said was that the carryover balance, if someone has $500 in carryover from last year, the employer needs to consider that when determining whether a participant has underspent or overspent their account when they terminate participation. So just as an example, if an employee terminates during the plan year after contributing $500 for the year and being reimbursed $750, if you look at just that first sentence there, it looks like the employee has overspent their account. They have been reimbursed $750 and only contributed $500. So if you can ignore carryover, this individual would not be eligible for COBRA. So COBRA would not be offered to this individual if you just look at the first sentence. However, what the notice says was that you also have to consider carryover. So the employee had an additional $500 that they contributed last year that carried over to this year. And the notice says you have to add that into their unreimbursed funds, essentially their contributions. So if you add the carryover to what they contributed this year, that's $1,000, and they've only been reimbursed $750, so they have actually underspent their account. So that's the first big thing that the notice provided, was that it told us that the carryover balance needs to be considered when determining whether an individual has underspent or overspent their account. The next thing it said was, conversely, that the carryover balance cannot be considered when determining the applicable premium for COBRA coverage. Generally, an employee that elects COBRA has to pay a premium. For health FSAs, that generally is a pro rata monthly share of their maximum benefit to them for the year. So if they elected $1,200 for the year, their monthly COBRA premium is generally 1/12 of that, or it would be $100 a month. And the notice says that you can't add the carryover to that maximum balance, and it makes sense because the employee already contributed that money last year. So you can't consider the carryover when determining the maximum COBRA premium. And the third and final thing it said about COBRA is that a COBRA beneficiary with a balance at the end of the limited COBRA plan year should be given an opportunity to roll over the carryover funds to the following plan year if active employees are allowed to do so. And that's sort of a modification of limited COBRA. As I said on the last slide, an employee that elects COBRA for the FSA generally only gets that FSA through the end of the plan year. The notice modified that somewhat, that said if the plan has carryover, then the employee should be allowed to carry over beyond the plan year and continue to use that carryover money. Even though they might not be able to make a new election, they can carry over the money as a COBRA beneficiary. In addition to COBRA, the notice also said two other things about carryover. First, it said that in order to have access to the carryover funds, the employer can require the participant to make a new election in the plan year. So if I have $500 at the end of the plan year, the employer can, if they want, say that I have to make a new election next year in order to get that $500. And then finally, the notice said that the employer can limit the maximum time an employee has to access that carryover amount. So if I carry over $500 and I don't make a new election, but my employer lets me use the carryover next year, they can say that I have the carryover for 1 year, but no longer than that. So those are just a couple of additional considerations and some clarity that the notice provided to us regarding carryover. I wanted to talk briefly about the FSA Maximum and some other ACA implications. Up to this point, we don't know what the FSA Maximum is yet in 2017. I think the last couple years it actually came pretty late, maybe late November or early December. So at this point, we still don't know what the maximum is going to be for 2017. I would expect that it either remains the same at $2,550 or increases maybe $50 to $2,600. But as soon as we know what the maximum is, we will let you know. And of course, there are some other ACA implications for FSAs, many of which you are aware of and have been implemented in the past several years. FSAs now can reimburse expenses for children up to the age of 26. I think everyone's pretty comfortable with the age 26 rule for qualifying dependents. The ACA also now requires that any over-the-counter drugs or medicines submitted for reimbursement by an employee must be prescribed. Prior to the ACA, it was possible just to purchase over-the-counter drugs without a prescription and submit it for reimbursement, but that's not the case anymore. Prescription is required. A couple ACA requirements, PCOR and reinsurance fees, neither of them apply to FSAs. And then finally, the Cadillac tax. The FSA contributions could, at some point, count towards the cost of coverage for Cadillac tax purposes. The problem is we don't know when or if the Cadillac tax will ever go into effect. It's been scheduled to go into effect previously and has been pushed back to 2020 already. So again, it's still unclear, but legislation at this point has pushed it back to 2020. I also wanted to talk about health FSA and HSA eligibility because HSA are becoming more common, and especially as we move into the new plan year for 12-1 and 1-1 plans, I wanted to talk just briefly about how health FSAs impact HSA eligibility and what employers implementing an HSA should consider. The first thing to know is that general purpose health FSA coverage impacts HSA eligibility, and what I mean by that is someone covered by a general purpose health FSA is not eligible to contribute to an HSA. That includes the employee that's covered and any spouse or dependents that are covered by the health FSA. So employers that are offering an FSA but are considering adding a high deductible health plan and HSA option at renewal need to assess how the FSA will affect participants' HSA eligibility. Again, during the current plan year, if someone is covered by a health FSA, they are ineligible to make HSA contributions. The questions come up then about how the FSA carryover impacts HSA eligibility. And really what we've learned is that someone that's participating in the FSA this year and wants to participate in an HSA next year, but they have health FSA carryover money at the end of this year, they have two options in order to start contributing to the HSA next year. And those two options are either to waive their carryover amount. So on December 31st, at the end of my FSA plan year, I have $10 left in my FSA. My plan has the carryover, but I want to contribute to an HSA starting January 1st, the first day of next year. So I just tell my employer I don't want the $10 of carryover and I'm good to go with HSA contributions. My second option is to roll that $10 over into a limited FSA if my employer has a limited dental vision FSA option. I can carry over my balance into a limited FSA, which does not impact HSA eligibility. The carryover is now more common than the grace period, but if you do have a plan that still has the grace period also impacts HSA eligibility. Participants that exhaust their funds by the end of the plan year can contribute to an HSA the first day of the new plan year. Participants that have a positive balance at the end of the year must wait until the grace period ends in order to contribute to an HSA. And what that means for calendar year plans is that the grace period ends in the middle of March, and so the employee must wait till April 1st if they have a balance at the end of the plan year. At the end of the FSA plan year, they have to wait until April 1st in order to start making HSA contributions. So I think it's important for employers to consider these issues, and especially to educate your employees about what that means, what having an FSA means for HSA eligibility. Next, I wanted to switch gears a little bit and talk about HRA and the HRA legal requirements. HRAs are another mechanism to reimburse employees for their eligible medical expenses that they pay out of pocket. The difference generally between FSAs and HRAs is that an HRA must be 100% employer contributions. So, and if an employee is contributing to an HRA, it really is not an HRA. HRAs are 100% employer contributions to assist employees with their eligible medical expenses. I'm not going to go through the whole list of rules again because many of these listed here apply, and we went over them in the FSA section. The slight difference is with COBRA. All HRA plans are subject to COBRA, full COBRA, so there is no difference between offering COBRA regarding your HRA and your major medical plan. COBRA, like generally now we're going to talk about HRA plans are linked or integrated with the major medical plan. So if you're going to offer, you need to offer COBRA for the medical plan and the HRA, so you might consider evaluation of the HRA for COBRA premium purposes, because the employee can only continue COBRA coverage if they pay an applicable premium, and you are permitted to charge a premium for the HRA. So that's one consideration you may think about regarding the HRA and COBRA. And actually, I want to say a couple additional things before we get into the next couple slides. There are some ACA considerations which are not listed on the slide, such as PCOR, which do apply to HRAs, which we have assisted our HRA clients with filing and paying at the end of July. So HRAs are subject to PCOR, but they are not subject to reinsurance fees. Most HRAs are also not subject to ACA mandatory reporting. And so those are just a couple of ACA considerations that aren't listed on the slides, but may have an impact on the HRA, and in this case it's just PCOR fees that do in fact apply to the HRAs. The big ACA consideration for HRAs is the fact that we can no longer have standalone unlinked HRAs. Those types of HRAs are no longer compliant due to the ACA. And the reason for that is the ACA has market reform rules which apply to group health plans that prohibit annual or lifetime limits. The HRAs are group health plans subject to those rules, and by their very nature can't satisfy those rules because by definition the HRA has an annual limit that it pays out. And so the HRAs can no longer by themselves satisfy the market reform rules. So the only way now essentially to offer HRAs are as linked plans that are linked and integrated with the group medical plan that by itself can satisfy the ACA market reform rules. So HRAs that are linked to group health plan are compliant. HRAs that are not linked are generally not compliant. There are a couple small exceptions. Dental or vision only plans don't need to be linked to a group health plan. Retiree plans, you can offer an HRA to retirees only that doesn't need to be linked to a group health plan. And then also an HRA that is only available to one participant is not considered a plan. And so again, under the ACA rules, HRAs cannot be linked or integrated or they must be linked or integrated with the group health plan. They cannot be linked or integrated with individual coverage, or they cannot reimburse individual or marketplace premiums. And so I wanted to talk about what that leaves us and what types of plan designs are still available after the ACA. As I said, ACA standalone HRAs generally no longer available as an option. That's really had a negative impact on many small employers who didn't offer a group health plan because it was unaffordable but wanted to do something for their employees, so they provided an HRA to reimburse some of their employees' expenses. We're hoping nothing obviously is going to happen before the election, but there have been some bills introduced recently that could alleviate some of these rules, especially for small employers. I know there are specific bills out there that could potentially accept small employers from these rules and allow them to do various things like have an unlinked HRA or allow small employers to pay certain individual premiums for their employees. Obviously, again, nothing's going to happen until the election is over, but I think regardless of the outcome of the election, there is some bipartisan support for some of these small types of changes that could help some small employers. So right now, no standalone HRAs. By far, the biggest plan design for HRAs still in effect are deductible reimbursement plans. Clearly the majority of plans. And the plan design, the one good thing about these plans is flexibility. They vary greatly in terms of plan design of the reimbursement structure, whether they reimburse first dollar expenses or the employer is responsible for some money before the HRA starts reimbursing. There's also they also vary greatly in terms of the amount of reimbursement, so there is flexibility there. And it's certainly dependent upon the specific employer objectives. And one way or one reason many employers are looking at this is simply as a way, of course, to lower their costs. So rather than paying increase in health plan premiums, the group will go to a higher deductible plan that maintains their premium at a certain level, or even decreases their premium, and then help employees offset the cost of the increased deductible by providing them with an HRA. HRAs are certainly a valuable tool also for employers to assist with HSA eligible health plan deductibles. HRAs can be compatible with HSAs if they do not reimburse expenses until the HSA minimum deductible has been met, and that is $1,300 for self-only coverage and $2,600 for family-only coverage in 2016, and that those minimum deductibles remain the same in 2017 as well. So the HRA, if designed correctly, if not reimbursing until after those minimum deductibles, can be compatible with an HSA. So again, deductible reimbursement plan, by far the biggest type of plan we are seeing plan design for HRAs. Coinsurance reimbursement is just sort of built on top of that deductible reimbursement type of plan. Also continues to become a little more common. So not only will the plan reimburse the deductible, but also once the deductible has been met, the HRAs can also reimburse coinsurance and prescription expenses as well. Full 213D HRA plans are also still available if they are linked to a group health plan. So rather than just reimbursing deductible expenses, the employer can provide a full HRA plan that reimburses any medical expenses meeting the definition of medical care in 213D. So that continues to be an option, again, as long as it's linked to a group health plan. And so that would allow the employer to help employees with certain expenses that might not go towards the deductible, whether they're dental or vision expenses or just other general expenses, eye care, or just any other types of expenses. An additional type of design is the MERP design, the Medical Expense Reimbursement Plan, which you can also see there. That's the type of plan that is limited to one type of expense, such as a dental-only plan. So a Medical Expense Reimbursement Plan, a MERP design, is also a common tool that is continuing to be used. And then finally, retiree HRAs are actually on the rise in order to offer benefits to retirees and make sure to maintain the costs. Some employers that at some point had promised to pay insurance premiums for their retirees, those premiums are increasing, the costs are rising, so what the employer is now doing is implementing an HRA plan that gives a set amount to those retirees and lets them use it for any medical expenses they might need. So those are the continuing trends we continue to see regarding HRAs and HRA plan designs. As most of you probably know, and we've talked about in the past, but again, HRAs, there is no premium reimbursement of individual or marketplace premiums, whether through an HRA or some other mechanism. It's no longer allowed for active employees. That's the case whether the reimbursement for those premiums are taxable or non-taxable. And again, this has really impacted small employers and nonprofits that in the past would give money to their employees and say, we don't have a group plan, go buy your own individual insurance, and we'll reimburse you for it. So that it's really had an impact on those types of employers, small employers and nonprofits that would have that plan design. There's really not a great workaround here, even though there are some voices out in the marketplace that suggest there really is not. The only way to provide coverage for active employees with tax savings is through a group health plan. And so we just wanted to emphasize that nothing has changed here. It's possible that there could be some legislation for small employers, but again, no individual or marketplace premium reimbursement, whether through an HRA or some other mechanism. The last point I wanted to make was about claim substantiation. So claim substantiation is a requirement for both HRAs and FSAs. All of claims submitted for FSAs and HRAs require third-party substantiation. That substantiation needs to show certain things like the cost of the expense, the type of the expense, the date of expense, so that the plan administrator or the TPA can realize that the claim being submitted is actually an eligible medical expense, and the individual didn't go use it for some other types of expenses and use their FSA funds for some other type of expenses. Some TPAs or some other people believe that sampling is a proper method for substantiation, and what I mean by that is that rather than looking at every single claim, they look at maybe a certain percentage, 15 or 20%, and make sure that those claims are being adjudicated correctly, and if they all are, then that means all of the claims are fine. But the IRS has specifically said that sampling is prohibited. So sometimes we get questions from employees, especially. Employers and plan administrators generally are aware of the rules, but employees often ask why they're required to send in information so much. They might say that their prior TPA didn't require substantiation, but I just wanted to point out that claim substantiation is essentially required for every single claim that is submitted, and the reason we ask for it is because we have to ask for it. And that's true for paper claims, claims submitted, claims paid for out of pocket, and also claims paid for with the flex card. Every claim needs to be substantiated. Now, some flex card transactions can be auto-substantiated, which essentially means they're substantiated simply by the fact that it is paid with the flex card, and that occurs for certain copays or multiples of copays that occur at certain providers. So if you have a $20 copay at your doctor, the card can see that you're paying $20 at that particular provider, and will go ahead, and that's enough to substantiate the claim, and that's permitted. Other claims that can be auto-substantiated with the flex card include claims purchased at certain merchants that have the IIAS system. Essentially, if you go to Walgreens' computer system knows what's an eligible expense and what isn't, so when you swipe the card, it can at Walgreens, an eligible expense will automatically substantiate, no paper required to be submitted. And then finally, certain recurring expenses, if you submit orthodontia, an orthodontia invoice that shows you're going to be making the same payment for several months, we can set that up in our system, and when you swipe it, the recurring expense will auto-substantiate. And so I just wanted to point out the substantiation rules for both FSAs and HRAs. I also wanted to provide a snapshot of the claims that we have processed. And this is just a snapshot of 2016 from January through the middle of September. We've received over 270,000 total claims, both FSA and HRA. Of those claims, over 200,000 of them have been by flex card. Only 68,000 have been submitted via manual claim, whether that's a fax or through the website. So over 202,000 have been flex card claims, and of those flex card claims, 75% have been auto-substantiated. So 151,000 claims automatically substantiated by the employee swiping the card. So when the employee asks us why they have to submit so much substantiation, so many documents, the fact of the matter is that actually 75% of flex card claims are auto-substantiated, and that number actually goes up to 82% for FSA card swipes alone. So if you take the HRA claims out, many of which require some form of substantiation, 82% of health FSA card swipes are auto-adjudicated. So I think that concludes today's presentation. I just wanted to give a quick update and refresher on FSAs and HRAs. If you need any assistance with administration for either of these types of plans, including the FSAs, including flexible benefit 125 plans, just let us know. And if we can also help with any compliance services, Form 5500 or wrap preparation, always feel free to contact us. I think I'm going to wrap it up there. Thank you for joining us today, and I hope everyone has a good day, and look for our invitation for our November webinar. Thank you.